here's the truth that most business owners don't realize. You can have great sales, strong margins, and loyal customers, and still be broke if your working capital is out of balance. Let's talk about working capital, because if you run a small, medium-sized business, this is one of the most important numbers you'll ever learn to control. And here's the truth that most business owners don't realize. You can have great sales, strong margins, and loyal customers, and still be broke if your working capital is out of balance. Working capital is the difference between your current assets and your current liabilities. Simple math, but the impact is massive. When working capital is tight, you feel it. Stress goes up, bills pile up, payroll becomes scary. Unexpected expenses become a crisis. When working capital is strong though, everything feels lighter. You make decisions from a place of confidence, not fear. Most business owners don't have a revenue problem, they have a working capital problem. And the good news is this: there are three moves you can make immediately that free up cash fast. Let's break it down. Part one, what working capital actually means. Working capital is simply the cash cushion that makes your business alive from week to week. Think of it like oxygen. As long as you have enough oxygen, you can operate normally. But when oxygen gets low, survival becomes, well, your full-time job. And here's where working capital gets misunderstood. It's not about how much you sell, it's about how long it takes to turn what you sell into cash. You can do $1 million in revenue this year and still constantly feel broke if your receivables take too long, your inventory sits too long, or your payables are too tight. That's why today we're focusing on working capital. Because the faster you move cash through your business, the stronger and healthier the business becomes. Here are 3 moves that free up cash the fastest. Move number 1, fix your receivables. Get paid faster. It's the easiest place to free up cash. Most businesses have thousands, sometimes tens of thousands, sitting in unpaid invoices. Money that belongs in your bank account, not floating around in somebody else's system. The reason this happens is simple. Most owners wait too long to follow up or accept slow payments because they don't want to feel annoying or they don't have a process at all. Let's fix this in 3 simple steps. Number 1, shorten your payment terms. If you're still using 30-day terms, you're basically financing your customers' businesses. There's no reason most small businesses can't move to 7 days, 14 days, or even due upon receipt. And before you think your customers will push back on this, they usually don't. Clean, clear payment terms signal professionalism. Step number 2, automate invoicing and reminders. Send the invoice immediately, not tomorrow, not Friday, immediately. And set reminders day 3, day 7, day 10, day 14. Consistency works better than confrontation. You don't need aggressive language. You need more predictable follow-ups. Let's go to step number 3. Offer fast pay incentives. A small discount for early payment is often worth the cash flow. For example, pay within 48 hours, I'll give you 2% off. It sounds tiny, but when cash is tight, 2% is cheaper than borrowing and stressing for weeks. That's the truth. Receivables are one of the fastest ways to improve working capital. Stop letting customers use your business as an interest-free credit card. Move number 2, fix your payables. Control how you pay. Just like receivables bring cash in faster, payables control how fast cash goes out. And this is where a lot of businesses shoot themselves in the foot. They pay bills too quickly, they pay vendors on terms that crush their cash flow. Let's fix that. Step 1, use the full terms. If a vendor gives you net 30, use net 30. Don't pay it on day 5, don't pay it on day 10. Use the time they've allotted. This isn't being shady, it's smart. That's what terms are for. When you pay early without a discount, all you're doing is tightening your own cash flow and giving your vendor a free boost. Step 2, negotiate better terms. A lot of vendors will extend terms if you ask. Not because they love you, because you have proven consistency. Ask for net 45. net 60, split payments, pay as you go, lower the minimum orders. You'd be shocked how many suppliers say yes once you build trust with them. Step number 3, match payment timing to your cash cycles. This is huge. If your big work or sales come in on Fridays, don't schedule vendor payments on Wednesdays. If you get paid every 1st and 15th, schedule payables on the 2nd or the 16th. Aligning payables with cash cycles prevents those midweek panic moments when your bank balance dips lower than the business is comfortable with. Your goal is simple. Slow down cash going out without damaging relationships. That one shift can save a business. Move number 3, fix your inventory. Free up the trapped cash. I've covered this in a previous video, but it belongs here too because inventory is one of the biggest working capital killers. Inventory is just cash wearing a costume. If you're carrying too much, your cash flow chokes. If you're carrying too little, the operations choke. Here's how to fix inventory quickly. Number 1, identify slow-moving items. Look at everything sitting longer than 30 or 60 days. Those are the things holding your cash hostage. Create a list and be honest. Step number 2, turn them into cash now. Discount them, bundle them, sell them to competitors, return them, write them off. Dead inventory is a cancer. Remove it. Step number 3, stop buying based on fear. A lot of businesses overstock because they're scared of running out. Fear-based purchasing is the #1 cause for inventory bloat. Instead, let's do this. Order smaller quantities. Order more frequently. Only stock what truly moves. Use supplier terms to your advantage. Inventory should be a flow, not a warehouse full of regrets. Bonus move though, use a 13-week cash flow forecasting. Working capital is all about timing. When money comes in, when money goes out, how long inventory sits, and how long receivables take. A 13-week cash flow model ties it all together. It shows your problems before they show up in your bank account. If you combine receivable improvements, payable control, inventory management with a 13-week forecast, your working capital will jump faster than almost any change you can make in your business. Where business owners often get it wrong, let's call out some of the biggest mistakes. Mistake number 1, trying to borrow your way out of a working capital problem. Debt is not the solution, it's a pause button. If receivables, payables, and inventory are broken, borrowing only delays the pain. Mistake number 2, thinking working capital improves from profit alone. Profit helps, of course, but working capital improves from your cash speed. Cash speed matters more than even your margins. Mistake number 3, believing this is just how it is in our industry. No, every industry can improve cash cycles. Trades, retail, agencies, manufacturing. Cash flow is a behavior, not a destiny. Mistake number 4, waiting too long to make changes. Working capital problems don't show up suddenly. They build kind of quietly. The longer you wait to fix them, the harder the fix becomes. Working capital is the difference between running a business that survives and a business that thrives. When it's tight, everything becomes difficult. When it's healthy, everything becomes easier. So your job is simple. Get paid faster, control how others pay you, stop letting inventory suffocate your cash. If you just focus on these 3 things, you'll free up thousands of dollars in your business without increasing sales or even changing your prices. All right, that's it for today. If you feel this helped you, make sure you subscribe and check out other videos on this channel. I'll see you on the next one.